Hello, everyone. Welcome back to the channel. Matt with Green Bar Trading here. Welcome back to another weekly watch list video where we go over everything you're going to need to know for the week ahead. And it is a huge week. There's so many things going on. So before we get into it, hit the thumbs up for the video. If you are new, click that subscribe button. All right. We're going to start where we always do, and that's with the earnings. The only difference is it's earnings season. Yes, I know it feels like it's always earnings season, but earnings season starts right there with the banks, with Delta on Thursday. All right, so this is highly anticipated. I understand everybody says that all the time during an earnings season, but what this does do is it increases a ton of volume in the market. With all that volume and all that algorithm trading, there could be some really good opportunities. We also want to hear, especially after the banking crisis, what these banks have to say. There's going to be a lot to digest. So that's the earnings right there for the week. All right, now going over to our sectors on the week and how they performed relative to the market. It looks like what we've been seeing and what I've been saying over the past two weekly watch list videos, there's sort of a rotation going on underneath the surface here. What we've seen all year long, looking at the 3-month relative performance, is technology, cyclicals, communication services have blown the doors off the market, just crushed it. While the defensives, which were great in 2022, have really had a rough time. We're starting to see some rotation, okay? Investors are starting to take those profits in the tech stocks. They're taking profits in those stocks that don't make any money, and they're starting to put them back into healthcare, into energy, into utilities. And we saw that again for the second week in a row. Even the financial stocks were on the plus side, while technology, was break even. So, and consumer cyclicals also down 1%. So this is interesting. We've been saying this for 2 weeks, and what has started to happen is the market is starting to trade differently. Now, before I get into the bonds and the economic calendar, I do want to say one thing here, and it's basically how you trade a market like this. Because even in my own trading, what I've been doing and what has been working really well is trading less, trading the extremes, right? Wait until a market is super overbought or super oversold, or stocks that are just way overblown that need a pullback. Use those moving averages as your guide to where those stocks that are really hot on RSI might pull back to, right? Do a little swing trading. But trading on the news has started to change a little bit, all right? And the momentum stocks that I love to trade, those cheap stocks that get catalysts, news, low float stocks, they simply have not been that good. So you need to know multiple trading strategies, all right? This is not, always going to be a crazy bull market that we've seen for the past 15 years. It's just simply not always going to be that case. So expand your knowledge, all right? That's the name of the game right now for 2023. So looking at the bond yields have been just a roller coaster. Now, the market was closed on Friday, and I'm going to go over the data that we saw from the jobs report. But the bond market was open, right? The futures market was open. Even though the volume was very, very light on the futures market, the bond market, well, the yield rose a lot. The bonds sold off huge. This is a very big move for just a 1 day of trading, and that's because of the jobs report. So what started to happen with the yields is when the yields go up, right? That's usually bad for the stock market. But what we saw on Thursday, the stock market rose, right? Yields have been trading just all over the place. So the news has not really been affecting the overall market the same way as it used to affect the market. All right. So going on to the economic calendar here, this is last week. What we're seeing is a very big slowdown in the economy. By looking at these numbers, these economic data numbers, there's definitely a slowdown happening. So the Fed increasing rates, that has started to affect the market. But what happened on Friday was the jobs number basically coming in line with the estimates of 238K. So nothing crazy here to get the market all riled up. The unemployment rate, well, that did drop to 3.5%. Expected was 3.6%. So we're seeing still a very tight labor market. All right. A lot of people are still employed, which is great. I don't want anybody to lose jobs. But this right here, 3.5%, that's simply no recession, right? So that means that it's going to be very hard to get a recession with the unemployment rate so low. So what is expected, unfortunately, is this is going to eventually go up. So that's what everybody's watching right now. You saw the initial jobless claims on Thursday. They were more than expected. All right. That's weak as far as the economy goes. The jolts on Tuesday, job openings, was less than estimated. Those numbers in the past have been the opposite of what we saw this week. So there's still that slowing in the economy that's starting to creep into the labor market. So I'm thinking that the jobs numbers in the next couple months are going to start to look a lot worse. That's just my opinion, but I think that's what's going to happen. And when that does happen, it's going to affect companies' earnings, and you're going to see really continued slowdown like we have been seeing, which is usually not great for the equity market. So as far as this week's economic calendar goes, this is what we have on tap, and it's not going to be any easier. We have the CPI on Wednesday. Just a huge market-moving economic data. Always is, always has been, but especially now, everybody's going to be looking at that core CPI. That's what the Fed likes to look at. X food, X energy. And then you have the minutes of the last FOMC meeting at 2 o'clock on Wednesday. And then on Thursday, you have the PPI. That's the producer price index. These are all inflation gauges. Huge. Jobless claims. Huge on Thursday. And then on Friday, this is when earnings season rolls on, starts to go with the banks. You have U.S. retail sales. Just a lot of economic data. Governors, Fed governors speaking. It's going to be a wall-to-wall economic data calendar. Going over to our compass, the SPY, all right? What do we see on this chart? What do I see? I see a very nice breakout, right? Higher highs, higher lows from those October lows on the SPY. Am I surprised that we slowed down right here last week? Not at all. We had this trend line, right? A trend line here that started back last summer, couldn't break here, and now we had our third touch here. So now that trend line is something that other traders are going to be looking at. You saw it drop here, price just once it hit here, supply zone dropped immediately, but then in low volume on Thursday, rose. Like I said, the market was closed on Friday. So the market could not digest yet those bond yield moves, which was very, very high. We're going to get a lot of volatility most likely on Monday because the bond yields went up so much. Now, I'm not also just looking at this trend line. Something that we looked at in our weekly watch list video from last week is you have this big volume ledge here. All right. When you hit these things, it's tough to get through because there was a lot of volume done here in the past year of trading. Not just this 2023, but all the way back to 2022. You can see that this was a big area here. So there's a lot of volume. When price comes back up, people that bought up here, well, they say, hey, I'm back to even. I never thought that would happen again. And they start to sell some of their positions. We've also seen a nice run up. You know, the Qs looks way more overdone than the SPY does, but the SPY is still up on the year. So it's looking strong. This chart is looking strong to me. Now, you do have this overhead supply, like I said. You have some key levels here, this 415, 420s. That's going to be an issue. I do not see enough risk to reward here. The upside, in my opinion, is limited. It's limited, especially because I feel like with inflation still going to be high, the Fed is going to need to keep rates higher, recession possible. That's going to affect corporate earnings that are simply not priced in for 2024 yet, right? The market always looks ahead. I don't see as much upside from here. So would people be piling in, big time investors and institutions? Would they be piling in as we go up higher? I personally don't think so. But that's just, like I said, my opinion. We had this nice breakout from the point of control, right? So you had this huge gap right here that we were talking about with the volume. Well, it got through that pretty easily. And then now we're going to be hitting back up to here. Previous highs maybe get tested, maybe not. Maybe we just go right down on Monday. But this is where we are. We could chop around for a little while. It's going to make trading more difficult. You have a little bit of this trend line acting as support. It's very steep. It's very steep at the moment. But if you do pull back, maybe that's where we see some support. It's not that far off. I don't really care that much about this trend line. I like trend lines that are more like this. This is very steep. But we're in an uptrend for the year, so we can't deny that. We're making higher lows. Right here where we tested this 480 mark, look at the volume that poured in to buy the dip. That's very bullish. That's very bullish. So just looking at the chart, doing some technicals, it looks like the SPY is in much better shape than if we went over to the Qs. All right, the Qs, the RSI is a lot higher than the SPY. It was just at overbought levels. I mean, this is just, it's a nice breakout. It's a nice breakout. But what I'm going to show you guys is this chart right here. This is the QQQ. This chart right here, well, it looks like about 3 stocks. 3 stocks that have a huge weighting on the Qs. Those 3 stocks look exactly like this. Everything else does not. So the market, the Qs, the technology stocks, well, it's being carried by just a few stocks. That is not a good sign, because if those 3 stocks that are all very elevated on RSI, if they pull back, well, the Qs are going to slide. So you have this trend line here. You have the point of control down here. This is getting really, really extended at the moment. Now, what stocks am I talking about? The top 10 holdings in the Qs. Microsoft, 12%, 12.5%. Apple, the same, 12.5%. This is a quarter of the Qs. A quarter. Nvidia, another one. Amazon. This is crazy. This is like 35 plus percent. Meta, which has been a huge outperformer. You're talking about 4 stocks here, 5 stocks that are 40, 45% of the Qs. And that's why the chart looks like this. So what am I talking about? Look at Apple. Very similar chart. And I'm just going to take away the volume. We don't need this anymore. Apple, very similar chart, right? For the year, higher highs, higher lows, a breakout. This looks exactly like the QQQ. Microsoft, same chart as the Qs, up at the highs here. Nvidia, same thing. Look at how extended this is. From the start of the year, up 100%. Up 100%. You cannot continue a move like this. It's simply not possible. So you're going to see some pullbacks. RSIs are very high. All right. So these stocks that have the big weightings, they're all at highs. If anything happens, if profit taking starts to happen on these super hot RSI stocks, right, which means overbought, it just means that these are overbought. If investors start to take profit and say, you know what, I've had a great run. That Q1 was great. I'm going to lock in some of those gains for my investors, right? These are going to pull back. That means that the QQQ is going to pull back, especially when these 4 stocks, maybe 5 stocks, have 45% to 50% of the entire QQQ. So be aware of that. All right, so that's the SPY, that's the Qs. You have the Dow Jones. This is what we said last week, that this 336 level might be resistance, and it was. So we're going to keep that on our charts. We also have this down trend line to contend with. So the DIA, I mean, looking at the chart, where is the risk to reward there? I don't really see it. IWM is building a little bit of support down here. You know, we do have a lot of those regional banks that are going to be, you know, having earnings reports. So that can affect the IWM. It has affected the IWM. This was looking really good until that banking issue. And that's why we're trading down here, just because of the banking issue. So keep that in mind. If that gets resolved at all, this one is going to come back up. So that's the IWM right there. I want to take a look and show you guys the VIX, because this is really important. We closed on Thursday right down here, basically the lows that we didn't see since the beginning of February. And now every year for the VIX seems to have its support. And I'm going to show you other years. But this year right here, around 18, that seems to be support on the VIX, where we top out in the market. And then when the VIX spikes, we see pullbacks. So we're currently here. So what would I think is going to happen? I think that we might see a pullback in the market, because that's where we're at. Just previous patterns. Every time we've come down here, the VIX goes back up a little bit and we see the market pull back. Now, as far as the years go, every year, I'm just going to take off these just to clean this up a little bit. But you can see every year has its own support, right? So you can see here, back in 2021, this was support right here, right, for the VIX. And then here for 2022, the support was around 19 to 20. This year, very clear, around 18. All right. And going back here to 2019, very clear level. So every time it's come here, whatever happens, algorithm trading, whatever you have, the market pulls back. Same thing here for 2018, right? Right here, very same thing for the year. You can see, I mean, it basically bounces to the penny. So why would I not think that this year is going to be similar? It has been every single other year. So I set alerts when this had gotten down to under 1850. That's where I was going to short the market. And that's what I did. I put on a bunch of shorts, and I'm going to swing trade this based on previous patterns, based on the fact that the Qs are extended up 23% or so for the year. A lot of those major stocks are very high on the RSI, overbought. So all of this goes into my trading thesis, and that's the reason why I traded. And you guys yourself need to take all that information in and develop your own trade plan, because that's what I did. Taking all this information, I don't just click the buy or sell for no reason. I have to do research and then get into my trades, and that's what we did. So I hope you enjoyed the video. Hit the thumbs up, and I'll see you guys on the next one. Take care, guys.